Welcome to the Opening Bell Report.
Okay, we need to talk about the chart. You know the one I mean. If you have the ticker POET on your watch list, that's POET Technologies, you probably opened your brokerage app today and saw a vertical red line.
Oh, yeah.
It was a gut punch. The stock's sitting at $6.22. That's, over 8% down in one day?
And it's been a rough week overall. It's significantly uglier if you zoom out.
It really is. And look, usually when I see a drop that sharp, that fast, my survival instinct kicks in, it screams, run. It just looks like a disaster.
It looks like something broke, fundamentally broke.
Exactly. But then this analysis report lands on our desk dated January 29, 2026, and the title is pretty audacious given the carnage. It's called Panic Selling or Opportunity, Why I'm Watching Pay at $6.20.
That is a bold title. But it really frames the central tension here, doesn't it? Is this a fire sale because the house is actually burning down?
Or is it a clearance sale because the store is about to restock with something much bigger?
That's the question.
And that's what we need to figure out. Because, I'll be honest, my first instinct is skepticism. A falling knife is a falling knife. But this report makes a pretty complex argument that the market is, completely misreading the situation.
Or at least overreacting to the mechanics of the deal and missing the big strategic shift underneath.
So help me understand what actually triggered this. We didn't miss a bad earnings call or something, did we?
No, nothing like that. It wasn't earnings. It wasn't a product failure. The catalyst was very, very specific. On January 22nd, POET announced a $150 million registered direct offering.
Okay, let's stop right there, because this is the part that I think always drives retail investors crazy. A company enlists they just got $150 million in cash.
Mm-hmm.
In the real world, that's great news. Your bank account is full. Why does Wall Street treat it like a crime scene?
It all comes down to the cost of that capital, the how. To get that $150 million, BGO had to issue new shares. We're not talking a small amount.
How many?
Roughly 20.7 million new shares.
Oof. Okay, so dilution.
Significant dilution. Think of it this way. The whole company pie got bigger because of the cash, but your personal slice of that pie just got a whole lot thinner.
And the market algorithm just does the math and hits sell.
It's almost purely mechanical. It's a supply and demand shock. You flood the market with 20 million new shares, and the price has to drop to find a new equilibrium. That's what we call the dilution penalty.
But there's a sentiment piece here too, right? The report talks about a bear case. It's not just the math, it's the message this sends.
Well, yeah. If you're a skeptic, you're looking at this raise and you're thinking,
why do you need so much money right now if things are going so well?
Exactly. The bears look at POET's current revenue, which is still, let's be honest, in the $1 to $2 million range. And they see this as an admission that the road to profitability is way longer and more expensive than everyone thought.
Right. It feels like a classic sell the news event. Everyone bought the hype on the way up to $9, and then the company says, thanks for the run-up, now we need cash to survive, and everyone just bails.
That is the narrative that's driving the price down to $6.20. But this is where the analysis in the report pivots, and I think this is the most critical part of our deep dive today. The analyst calls this $6.20 level a golden zone.
Which sounds incredibly optimistic for a stock that just got hammered.
It does. But you have to ask the next question. What did they buy with that dilution? What did they get in exchange for that painful price drop?
Okay.
And the answer, according to the report, is a fortress balance sheet.
Fortress balance sheet. I mean, it sounds impressive, but is that just a fancy way of saying we have a lot of cash now?
It's so much more than that. You have to understand where POET was before this deal. They were, like a lot of growth tech companies, living quarter to quarter.
Constantly looking over their shoulder.
Yeah, worrying about insolvency, which forces you into making bad, desperate financing deals, toxic loans, that kind of thing.
Right.
But now, after the raise, they're sitting on roughly $300 million in cash.
That is a lot of runway, but I'm going to push back a bit. Just having money in the bank doesn't automatically make your technology better. How does the cash pile fundamentally change the investment thesis?
Because of who they are trying to sell to. This is the nuance that I think casual observers are missing. It all comes down to one term, counterparty risk.
Break that down for me.
Look at their target customers. We're talking about giants, Foxconn, Luxshare, Mitsubishi. These are the companies building the physical backbone of AI and the internet.
The big leagues.
If you're a company like Foxconn and you're designing a next-gen data center module that needs to work reliably for 5 years, you simply cannot take a risk on a key supplier who might go bankrupt in 6 months.
I see. So if POET goes under, Foxconn's entire product line breaks.
It's a non-starter. You could have the best tech in the world, but if your balance sheet looks shaky, a tier 1 customer will not sign a long-term contract. They just can't. The liability is too high.
So the $300 million isn't just for paying the bills. It's a signal. It's a giant insurance policy for their customers that says, we aren't going anywhere.
Precisely. It removes the single biggest objection a massive partner would have to signing a major deal. The report's argument is that the pain we're seeing today, the dilution penalty, was the price they had to pay to unlock these huge customers.
So the downside is now priced in, but the upside of being a safe partner is just getting started.
That's the thesis.
It's a compelling pivot. We took the hit to join the big leagues. But that brings us to the actual product, right? You don't raise $150 million just to let it sit in a bank.
No, you raise it to build something. And this is where the report shifts from finance to, well, to physics.
The tech catalyst?
Yeah, and frankly, if you don't understand this physics problem, you can't really understand why this company even exists. We are hitting a literal wall in the AI industry.
The physics, well.
Right. We're moving to what they call scale-out AI. So instead of one giant supercomputer, you're stringing together thousands of GPUs to act like one brain. The problem isn't the chip anymore. The bottleneck is the connection between the chips.
And for decades, that's just been copper wires.
For decades. But copper has a physical limit. When you try to push data at 1.6 terabits per second, which is the new standard, through a copper wire, physics just says no.
How so?
Resistance, heat,
Right.
signal loss. I mean, you have to pump in so much power to push electrons that fast through copper, and most of that power just bleeds off as heat. It's incredibly inefficient, and the signal degrades so quickly you can barely get it across a single server rack.
So the industry knows copper is basically dead at these new speeds. We have to use light. We need optics.
Correct. But here's the catch. Traditional optics have always been kind of handcrafted. It's tiny lenses, lasers, mirrors. It's expensive, fragile, and it's really hard to manufacture at scale. You can't just print them like a silicon chip.
Until now, I'm guessing.
That is POAT's entire pitch, their optical interposer. They figured out a way to build these complex optical engines using standard semiconductor manufacturing techniques. So they're not assembling tiny lenses by hand. They're essentially printing optical pathways onto a wafer.
So it's like applying Moore's law, but for light.
That's probably the best way to put it, yeah.
Yeah.
And it allows them to mass produce these 1.6T and 3.2T optical engines at a fraction of the cost. And for these giant AI clusters where you need hundreds of thousands of these connections, cost and scale are everything.
Okay, but I have to be the skeptic again. This sounds amazing on a PowerPoint slide. We print light. But is it real? Is anyone actually buying this stuff, or is it still just science in a lab?
That is the multi-million-dollar question, isn't it? The report points to the end of 2025 as the moment of proof of life. That's when POAT announced they had received $5.6 million in actual production orders.
5.6 million. I mean, in the grand scheme of the AI industry, that's a rounding error.
It is, in dollar terms. But in terms of significance, it's massive. It proves the technology works outside of their lab. It proves a customer, likely a tier 1, tested it, validated it, and wrote a real check for a real product.
And that ties directly back to the cash raise.
Connect the dots. You get your first $5.6 million in orders. You know the demand for 2026 could easily be 10 or 20 times that. You can't fill those future orders if you don't have the components and inventory ready to go.
So this $150 million is essentially a war chest to build up the inventory for the big ramp up.
That's what the report suggests. You prove the tech works with small orders, you get the cash to build a metaphorical factory, and then you prepare to flood the market.
You're basically buying the company right after they've secured the capital to execute, but at a price that reflects the market's panic over the dilution.
That's the bull case in a nutshell.
So let's zoom out a bit and look at the playing field. PMT isn't the only name in this space. The report brings up their main competitor, Lightwave Logic ticker LWLG. They're always mentioned in the same breath. How do they stack up?
It's the classic rival comparison. And Lightwave is a fascinating company, no doubt. But the report argues there's a serious valuation disconnect. LWLG often trades at similar or sometimes even higher valuations than POAT.
But do they have the same commercial traction, the same partnerships?
And that's the core of the argument. The analyst points out that Lightwave is arguably less commercially mature. They have fewer confirmed production orders and fewer publicly announced design wins with giants like Luxshare or Mitsubishi.
So the asymmetry the report mentions is basically this. POAT is further along the business path with actual orders and partners, but it's trading at a discount because of this short-term financing event.
You're getting the more mature commercial entity at a depressed price because short-term traders are panicking about the share count. It's a value play disguised as a crisis.
All right, let's get into the technicals. And I know sometimes technical analysis can feel a bit like, reading tea leaves.
Financial astrology.
Yeah, but the report makes a big deal about why this $6.20 level is so significant. Why shouldn't it just keep dropping to $5 or $4?
Well, it's not magic. It's market psychology. The chart tells a story of where buyers and sellers have fought their battles before. And the analyst points to three converging factors right here. First, the gap fill.
Right, I see that on the chart. We had that monster rally from around $5.50 all the way up to $9 pretty recently.
And it happened fast. So fast that it left behind what traders call a liquidity gap. Very few shares actually traded hands in that $6 to $8 range on the way up. The market hates a vacuum like that. It almost always comes back down to fill the gap.
To test if there are real buyers at those levels.
Exactly. So we've reset to the launch pad. But look at where we stocked. The $6 to $6.15 range. For most of 2024, that price level was a concrete ceiling, a massive wall of resistance.
And the old rule of thumb is that old resistance becomes new support.
It's a floor test. If the stock can hold above $6, it confirms that the initial breakout was real. It tells us the market now accepts this as the new valuation floor.
The report also mentions the RSI.
The relative strength index. It's just a momentum thermometer, really. Before this big drop, the RSI was screaming overbought. It was over 75. The rubber band was stretched way too tight.
And now
It's collapsed. It's under 35, which is considered oversold. The rubber band has snapped back hard. It suggests the selling pressure is probably exhausted.
those are people who were going to panic.
They've already panicked. The weak hands are out. The retail investors who chased the hype at $8.50 got scared and sold at a loss. But you have to ask, who's on the other side of that trade?
The institutions who bought the offering.
The smart money. Someone just wrote checks for $150 million worth of stock. Institutions don't do that to lose money. They're quietly accumulating shares while the retail crowd is running for the exits.
So if I'm listening to this and I'm thinking, okay, maybe this isn't the end of the world, what should I be looking for? What's the timeline here?
Well, don't expect a V-shaped recovery tomorrow. The report is very clear about this. In the short term, say the next month or so, it's going to be choppy.
Chop City.
Absolutely. The market has to digest 20.7 million new shares. That takes time. We'll likely see the stock bounce between $6 and maybe $6.80 for a while.
So patience is key.
But look at the long term, 12 months, 24 months out. The single biggest risk for this company, which was dilution, is now off the table. They have the cash. They won't need to go back to the market for at least 2 years.
That clears the runway for them to just execute.
And if they do execute, if those production orders start to really ramp up, the analyst is targeting a re-rate back to the $9.50 to $12 range. That's a significant upside from here. But it all hinges on execution.
What are the signals? If I'm watching the ticker tomorrow, what tells me the bottom might be in?
You have to watch that $6 line like a hawk. It has to hold. If we start getting daily closes below 6, the thesis starts to break down.
Okay.
But specifically, the analyst wants to see a daily close above 640. That would be the first real confirmation of a reversal.
So $6 is the floor, 640 is the green light.
That's the technical setup. It's a fascinating clash, isn't it? The ugly optics of a price crash against the beautiful fundamentals of a fortified balance sheet. It really feels like a transfer of shares from the impatient to the patient.
Which is how the market works, I guess. The company just graduated from risky startup to capitalized partner, and the graduation party was just a little expensive for existing shareholders.
That's one way to put it.
I want to leave everyone with one final thought. We spend so much time talking about the AI gold rush, and everyone owns NVIDIA, right? Everyone is obsessed with the miners, the chip makers.
It's the obvious play.
It is. But think about the infrastructure for a second. If you have the fastest Ferrari engine in the world, that's your NVIDIA chip, but you try to connect it to the wheels with a rusted out bicycle chain, what happens?
The chain snaps. The car goes absolutely nowhere.
Exactly. The copper interconnects inside these AI data centers are that rusty bicycle chain. They're breaking under the strain. POET is building the high-performance transmission that can actually handle the power, and right now, the engine is way too powerful for the transmission.
So while everyone is staring at the shiny engine,
Maybe the smartest bet is on the only company that can build the gear that actually makes the whole car move.
it's the infrastructure bet. It's never the sexy bet until the old infrastructure fails, and then suddenly it's the only thing that matters.
Something to think about the next time you see a scary red line on a chart. As always, this deep dive is based on the report we analyzed and is for informational purposes only. We are your guides, not your financial advisors. Please do your own due diligence.
Read the filings, check the sources, and make your own calls.
Thanks for diving in with us. We'll see you on the next one.
Don't forget to like, share, and subscribe for more.